Hello everyone, Polarity is here and I'll be your host and I'll be your tutor on a particular subject titled directional bias. Okay, in this session, I will break down the most easiest way to frame a directional bias in just two steps. Just two steps. Okay, directional bias is so important for every trader because why? If you know how to frame a directional bias the right way, you can, your problem as a trader is solved 70% of the time. It's solved 70% of the time. That you know exactly when price is supposed to start buying and when price is supposed to start selling, and when to stop looking for buys and when to stop looking for sales. All right, this concept will also teach you as a trader, all right, as a crypto trader, as a forex trader, to know when there is a price exhaustion, there is price is ready to be in like a bullish sequence and in a bearish sequence. So follow me one step at a time. So the two things we are going to be I'll be using two things to explain this concept. Number one is liquidity. Number one is liquidity and then number two is imbalance. Okay, so price is drawn to two things. The way you are seeing this whole market like this, without no candle, without no joints and so on and so forth, one thing you want to understand is price is drawn to liquidity. Price moves from liquidity to liquidity. For an example, price now, when we talk about liquidity, there is a liquidity above an old high and below an old low. Just staring at the chart like this right now, you will note that price is above this. Liquidity is above this old high, all right, in form of a buy side liquidity. Coming in form of a buy side liquidity, and there is a liquidity below an old low in form of a sell side liquidity. So if price clears this high, means price cleared the buy side liquidity, and if price clears a low, means price cleared a sell side liquidity. Now let's break it down. Now that's one thing you want to get for the part one. And the second part is the imbalance. Imbalance is most definitely a fair value gap. Now, how do you identify a fair value gap? Pay attention on how to identify a fair value gap. So you have a candle closing at this high, right? You also have a candle closing at this second high. You see this gap inside this gap, that candle that this shadow candle is not passing through, is called a fair value gap. So that's how to identify a fair value gap. Now, also, also, price is drawn to two things. When price clears a liquidity, for an example, if price clears a liquidity like this, let's start from here. If price clears a liquidity like this, price is drawn to two things. Number one is the imbalance. For an example, I'll be using this example on GU. If you want to frame your directional bias, okay, there are various ways to frame a directional bias. This is just one of them. All right, this is just one of them. So pay attention. Price is drawn to two things. The number one is the imbalance, which is most likely, which is always your fair value gap while framing your directional bias. So this is fair value gap. Let's name that fair value gap. All right, when price cleared this high, okay, makes an high, then reverse into this fair value gap, all right, to trigger this fair value gap as an imbalance. Then after this fair value gap clears this high, all right, trigger this fair value gap to clear a new high. Okay, after clearing that new high, there's now a new liquidity above this high. So price reverse, retract into this new fair value gap like this. All right, to go and clear this liquidity above right here. This is another buy side liquidity. Okay, when price was moving, price made price revert retract into this nearest fair value gap like this, all right, before making a new high. So automatically this is just going to serve as a new liquidity zone. So price reverse into this fair value gap to clear this high again, and that's how market moves from liquidity to liquidity. So for an example, price cleared this low right here. This is the sell side liquidity. Pay attention. Then price was moving, and it got to a point, a, an imbalance was created right here. Price used this as a liquidity zone, and this automatically returned to a sell side liquidity, that when price trigger this fair value gap, it will automatically anticipate that price will dump into this sell side liquidity. And that's how market moves from liquidity to liquidity. Also, there's another one right here. After price cleared that zone, there's another one, a little one right here, before price now dumps to this low. So price is in an exhausted phase right here before, and there's a way to know how market is going to reverse from here using market structure shift. All right, you can do that on the lower time frame confirmation, but on this particular session, let's call this a market structure shift. Let's call this a market structure shift. That I market structure shift. So after a market structure shift, you will discover that price retracts into a favor. This is a fair value gap. All right. Then price trigger this favor. Price create a fair value gap at this high. Then reverse into this fair value gap to clear that external range. If you go into the lower time frame, you will see it more clearer. Let's go into the lower time frame. You will discover, can you see, this is the fair value gap on the weekly time frame. Price make this high, retract into this fair value gap to make a new high. So let's go back into the weekly time frame so everything can be clear. So if you are framing your directional bias, you want to start from the monthly time frame, weekly time frame, and your daily time frame. Okay, if you are not seeing your fair value gap on the weekly time frame, you might as well come to the daily time frame to check it out. Okay, so after price cleared that high, okay, a new fair value gap was created. After this high, price reversed into this fair value gap to trigger this fair value gap to also, so automatically, if price hasn't get to this point, we could actually be targeting this high. All right, that price is going to reverse from this fair value gap to go and clear this high, and that's how market moves from liquidity to liquidity. This is a new high. This is the maximum height that the price reached. This is a fair value gap created. All right, this is a fair value gap created because you can't see a gap inside. You can't see a shadow candle inside that zone. So can you see price made this high, reverse into this fair value gap to make a new high? Okay, so price clear this high. So after price made this high, like this, price reversed, all right, to come and also trigger this fair value gap again before clearing this old high again. If you go into the lower time frame, like the daily time frame, you will see it. Can you see price reversing to the fair value gap before clearing this high? Framing directional bias in just 2 steps. Just 2 steps. Let's also check BTC USDT. All right, I won't be making this session too long. Okay, let's clear the whole chart, remove all drawings. Let's start from the monthly time frame. This is exactly how I frame my directional bias. So after price cleared this external high, all right, you anticipate that price will trigger a fair value gap. This is most definitely a fair value gap right here, that price used as a liquidity zone to clear a new high. So this is a new high at this point. So price was still moving, then create a fair value gap as a retracement. So can you see price triggering this fair value gap as a retracement to make a new high? Let's go into the lower time frame. To confirm this. Okay, right now what we most definitely anticipate on BTC is when price clear this high, we will anticipate that price will trigger this fair value gap, a new fair value gap right here, before absolutely making a new high. And that's how market moves from liquidity to liquidity. This is how to understand market from market from from a bigger time frame. Now let's narrow down our search on the weekly time frame. This is on the weekly time frame now. After price clear this high, all right, on the weekly time frame, I will show you how important a fair value gap is in the market. All right, this is one. This is one fair value gap that creates this movement. All right, this impulsive move, after being created, price couldn't like break it, so came for this second fair value gap like this before triggering, before clearing that high. Okay, I think the only reason why price could have reversed to this point is also another confluence you want to that is also going to give you more accuracy is measuring your premium and the discount pricing. All right, now how do you measure your premium and discount pricing? If you notice, if you are measuring from the previous zones, you discover that price is trading to 0.5 level, so means market has been efficient at this point. Market has been efficient at this point. So the point where market stopped to be efficient was this zone like this. Pay attention. Was from this zone. Can you see that market didn't trade to the 0.5 level here? So you're just going to drag it from that inefficient zone to the high created. So if you want to know the most definite way that price is going to come down there to come and reverse, so this is how to exactly know how. All right, this is, can you see this fair value gap? I mean, this fair value gap is inside this efficient market just to come and make the market balance. All right, one thing you want to know as a trader is buyers must be equal to sellers. All right, one is not bigger than the other. All right, once buys are flowing in, once buys are getting efficient, sellers also has to be getting efficient. Okay, I'm still going to explain that extensively in perhaps maybe the next session. So that's an efficient market. All right, if you catch a trade at this fair value gap, you could swing to this high right here. All right, you can go into like your lower time frame to your entry confirm, any type of entry confirmation you use. You can use it to get your entry at that point. Now let's take it a step further. Liquidity sweep. Liquidity sweep. All right, price was still buying. This is a fair value gap. This was the first fair value gap that price used to create this retracement. Okay, let me show you guys clearly. Can you see that this is a trigger? So fair value gap is a very important factor in trading. So as at this point, if you get to measure, let's check where inefficiency started. You discover that this is trading to 0.5 level. Market is efficient at that point. Let's also measure from here to this high. You discover that this is also trading to 0.5 level. So that's an efficient market. Let's also measure from this low to this high. This is price is not trading to 0.5 level from this point. So that's where the inefficiency started. So if you ask me, quite alright, that why didn't this fair value gap like make this impulsive move, means price is not like, the market is not efficient at this point. So after clearing this high, is not efficient still. So the most immediate fair value gap that price is going to definitely use is this one right here. So you could have actually anticipated that price will trigger this fair value gap right here to make a new high. And that's so easy to understand. So easy to understand. Now when price trigger this fair value gap right here, then clears this new high, this was the immediate fair value gap that price used again to continue the to make market continuation. This just quickly trigger this zone to make a new high. But then this zone created didn't give us an efficient market. So made this new high. So you just want to keep on measuring from where the inefficient started. All right. Perhaps you'll be anticipating that price is going to trigger this 0.5 level. But what will make you know that market is going to be buying and selling and buying is order flow. And I'll be breaking order flow down in the next video. All right. So if you are not subscribed to this channel, make sure you click on the subscribe button, and also drop all your questions in the comment section. I will always check them through. So let's take it a step further. So this is an efficient market right now. So this, when price cleared this high, price also cleared this high like this. I don't know if you guys can see it, but price cleared this high. Let me zoom in. When price cleared this high like this, you will discover that price trigger this fair value gap right here, this small fair value gap before clearing. All right, made this high, retract into this fair value gap before clearing that high. Now after clearing that high, price is currently using this fair value gap as, because after clearing that high, this will automatically turn to a sell side liquidity. Remember, we've been clearing buy side, buy side, buy side all along, buy side, buy side, and buy side all along. But right now, price is trying to use this fair value gap as a retracement. After this market structure shift, we most definitely see BTC, all right, trying to trigger this next fair value gap at this low right here, possibly. All right, and that's how market delivers from liquidity to liquidity. Now let's go into the daily time frame also, because I told you you can do this on your monthly time frame, your weekly time frame, and also your daily time frame. All right, there's really nothing much to see here because price is now in a very clumsy situation right here. But then once you come to the lower time frame, all you want to pay attention to is if the swings are correct. Okay, where you are measuring your inefficiency from, you discover that all these zones are efficient, but markets start to be inefficient from this low to that particular high. So you can use your daily time frame to know where market is inefficient. So if you find this video useful, make sure you drop a subscribe, make sure you subscribe to the channel, and also drop a like, comment on this video. I will catch you guys on the next one.